We are going to continue to set up the portfolio problem, but now we're going to look at the returns and risk from a portfolio. And remember, a portfolio includes more than one asset, so this gives the portfolio return, which is a combination of assets. We're going to assume the following. Asset, if we have a stock, for example, Bayer and Amazon, or any other, we can completely summarize those assets by two measures: expected return and a measure of variance. Standard deviation or variance. Expected return gives us our return. Standard deviation gives us our risk. We actually know that those two assumptions are not correct. There are many distributions that have fat tails or other irregularities. In fact, go look at the stock market returns that we showed in class from 1929 through 2019, and they have fat tails. All right, so we know that this isn't the best assumption, but we also know that it's what we're going to work with as we're moving forward. All right, so expected return, standard deviation are our measures of returns from our assets. I'm going to introduce a little notation. We have an expected return mu from each asset. We know the standard deviation of each asset. If we know the standard deviation, we know the variance of that asset, which is just the standard deviation squared. And the last thing that we need to know is the correlation between asset 1 and asset 2. All right, correlations, 1 to -1. 1 very perfectly correlated, -1 perfectly negatively correlated. That's what we're going to use to characterize our assets. And the big thing is the correlation again. We want to focus on that correlation as we're combining assets. All right, if we have two assets, the proportion that an individual invests in one asset will then determine what is invested in the other asset. So two assets, if we say we're going to invest 40% in asset 1, that means we're going to invest 1 minus 0.4 in asset 2. We're always going to assume that the amount that is invested equals 1. So if we have two assets, we have one decision variable. What amount to invest in asset 1, that determines what we then will invest in asset 2. All right, we know that. I am now going to show you the formulas for expected return and variance. These are statistical formulas. They are true, they are accurate, they work outside of finance as well. If you have any old assets, this method will work for coming up with the combination of assets. One important to note, if we assume that the assets themselves are distributed normally, the portfolio returns will also be distributed normally. All right, here are the two formulas. The expected return is the average, weighted average of the returns from the two assets. The variance, you see the formula there. The standard deviation is the square root of that. Note this term right here. This is important. This will determine the risk reductions associated with combining assets, and we'll talk about that more in further modules.